Good morning, everybody. Happy Monday. Happy Monday. We'll get started here in just a minute. Got a few important things to go through here this morning as we start a pretty busy week on the economic data front. And of course, not a whole lot left on the clock here for the year. But certainly 1 week here, I think that's going to be important here. So we'll get started here in just a second. Yep, and thank you for the audio and visual test. It sounds like we're good. That's great. How many of you feel like things are slowing down a little bit slowly for the year? Does anyone have that feeling yet? Yes? Maybe? No? What do you guys feel like? I went to the gym this morning, and I can tell you there's a lot less people, partially because I live in the city here, and there's a lot less business travel already at this time of year. So those people are gone, or less of them. Typically, business travel really starts to slow down dramatically just around now. Around the 15th to 18th of December is typically when things start to slow down. So anyway, but we're here, so thank you all for joining. If you're here for the first time, thanks for being here. I'm Serge Berger from thesteadytrader.com, and we are going to spend the next 10, 15 minutes or so going through some of the top things on my notebook. If you're here for the first time, thanks for being here. We appreciate it. We do this morning call Monday through Thursdays, so we're excited to be here today to be able to share with you what we are looking at here today and the next this week or so. This is also a great time of year to really start preparing and looking at our actual portfolios. For those of you that have portfolios, which is probably the majority of you, investment portfolios, this is a great time of year now, this week, maybe next week, but really this week, it's kind of like the last one, to really start looking into what changes you may want to make, depending on the tax situation that you have. Obviously, we can't give advice here. This is just educational. Changes can also be implemented, of course, in the new year. But the point is really kind of think ahead and kind of be thoughtful and take this somewhat slower time of year to be a bit reflective in terms of what did work for you this year, what didn't. Maybe you should make a change, maybe you shouldn't, right? Those are all personal things, but we're spending a lot of time talking to our clients about that right now over on the investment advisory side. That's a separate company called Blue Marlin Advisors, where we are investment advisors for our clients. And that's basically what the conversations are all about, is kind of making sure we're positioned for what we think is going to be a different regime in 2026. We've already seen what happened in 2025, where tech stocks were no longer the only game in town. In fact, as you'll see here, let's bring it up right now. I like to remind people every single morning of what's slowly starting to take place. Let me quickly update this chart here so you can see this a bit better. So this is particularly for those of you that are new, but this is the year-to-date performance of stuff. You can see gold miners and gold and platinum and all those things we've been talking about now for some of those we've been talking about for 3 years now. 2.5 years almost. 2 plus years. Some of them are a bit newer, like for the past, let's say, 9, 12 months. But they've all basically outperformed and beaten the living daylights out of, the Mag 7 tech bubble. The NASDAQ is up 20%. The NASDAQ 100 is up 20% year to date. That's a great performance chart. That's great performance. But it's getting beaten. And it's at the margin because we're starting to see people reallocate and rebalance portfolios, which is, from a risk management perspective, what really makes sense to us. The S&P is up 17%. These are great returns, but they're no longer keeping up with what some of these other moves are. And we believe we're going into a regime over the next 5 to 10 years, where you're going to see the S&P 500 dramatically underperform many things because of the large weight of the S&P. So what does that mean? Well, as we head into this week here, again, we've got a pretty heavy calendar from a economic data perspective. I want to just show you a couple of charts that I think, this is just the chart stuff, and then we're going to get into some bigger picture stuff that I think is very, very important. So we'll keep it a bit simple here, but what I thought I would do first is more sort of for the immediate gratification people among us here. I want to just show you something that I know that no one's talking about. And this is just thought provocative. I don't really have a view on this, particularly not at the end of the year. But for those of you that are just, again, a bit more near term and purely technical focused, I would keep an eye on NVIDIA. Why? Well, it's NVIDIA, right? So we need to keep an eye on it. But also, I really have yet to find anyone that is giving any, and I mean any, notice to the potential thought that we're putting in a head and shoulders topping pattern in NVIDIA. I don't have a position. I don't want to have a position. To me, this is just way too much of a passive investing bubble. That's not a value. That's not a call on the stock itself or on the company. Certainly not. It's not a call on not liking. As some of the other told me that I'm bearish AI. It's not even close to the case. I think we live in an allocation bubble. That's a very different thing. Anyway, NVIDIA, just a thought here. It may be something that is putting in a head and shoulders pattern. It may be. I have no position. I thought I would point it out to you. So just as an FYI, just do your own work. Have a process. Don't listen to the bubble talk people on financial TV, because they only have one thing in mind, and that's for you to buy their bubble. So just keep that in mind. I'll give you a couple other names that I think are worth pointing out. CoreWeave is another one of those names. For everyone talking how amazing this company is, the reality is this stock peaked in June, and it's since down almost 60%. It was down 60%, it's now down 57%. So you just have to be very careful right now in this environment. One of the things we've talked about a lot is Oracle. We called out in September when we had that big rally higher in Oracle based on them promising us that they have incredible visibility 10 years out or something stupid, which is a complete lie. The stock basically since gapping up is now down a solid 45%. So just please be careful and do your own work, and don't believe a lot of the stuff that's floating around out there. Now, there's one really, really, really cool idea that I have that I will reserve for people in Set the Market. That's in Trade Ops. That's our chat area on Slack. So if you are in Trade Ops, I'm going to show it to you in about, 10, 15 minutes, maybe 15 minutes. I'll show you what I think is an incredibly interesting idea, something very juicy, very near term. It's very asymmetric in terms of the payoff with options. So I'll reserve that one for you guys over in Trade Ops in about, 15 minutes or so. But I do want to point out something that I think is probably the most important piece of research that I did over the weekend. And so I'd like to share this with you guys here as well. So if you look at the allocation of sectors in the S&P, and then you can look at it globally, which we'll look at in a minute as well. We've talked about this now for a long time. But you know that the information technology sector or the tech sector is about 35% of the S&P or the SPY ETF. You add to that the consumer communication services sector, which is about another 10%. And then another couple of stocks like Amazon and Google, and you're pretty quickly at about a 50% weight of the tech sector in the S&P 500. To give you an idea of this, I actually ran some numbers that I came across. I'm going to quickly share them with you. So basically, we have let's see here, what are the numbers? And these numbers are not going to be, you can write them down if you want, but the NASDAQ 100 has over the past 3 years basically increased in market cap from, I believe, 12 trillion to 32 trillion, right? So that's 12, 24, 30, 36. So it's like, a massive move. Other parts of the market, like energy, for example, is actually flat. It has not increased at all over the past, I think, 3 years or so. So I want you to think about this when it comes to an asymmetrical risk setup heading into this new year and then probably for years to come. Now, before I go into it a bit more, I'm going to show it to you one more time in a different way. If you look at the MSCI Global Index, I don't know how many of you know about this index or even care, but this is really, really important. So maybe write this down. So the MSCI Global Index, the MSCI has a whole lot of indices globally. They're tremendous indices. And one of the indices basically measures, collects all or puts all the globally traded equities, publicly traded equities, into one index called the MSCI Global for a reason, right? Now, if you look at this, and you may have to squint a touch, but you'll see this, what is that, pink color? That's the United States stock market. It's currently 72.5, call it almost 3/4 of the global equity market cap. If it wasn't for the massive heavy tech sector, it would be nowhere near there, right? It would still be significant, as it should, because the U.S. is obviously a powerhouse. However, that's both the risk, but also the opportunity. Okay, so let's be opportunistic here and see and let me get to the point what I'm trying to say. Now, I'm going to go back to the previous chart here. You're seeing the same idea, but here now more on an S&P 500 centric look. If you think about how large the tech sector is, and again, it's not just 35%, it's really more like 50% if you add it up in a fair manner. It's going to take so little money to be reallocated, just from a rebalancing perspective, out of tech into some of these smaller sectors, particularly energy and utilities that we really like, right? Utilities have already had a great year this year. They're up 16% year to date. That's in line with tech, right? And tech is a few stocks. Utilities is much more balanced. So if you think about an asymmetric setup, and this is one of the things we're talking about a lot of our clients over at Blue Marlin Advisors, again, the investment advisory firm. This here is purely educational. As you guys know here, we're not giving advice here. If we are looking for, let me put it this way, I have to be compliant. We are looking at this from an asymmetrical setup perspective. If we believe, and we do, our research indicates that more and more money is getting rebalanced out of tech, not away from tech, meaning it's not like people aren't like dumping all the tech stocks, but there's a lot of reallocation happening. It's been happening for 19 months now or more at the margin. It takes so little to cause a big, meaningful pop in some of these other sectors or even other parts of the world, right? You've already seen that this year with, for example, German stocks, right? There's so much damn money in these tech stocks that any marginal rebalancing as it continues, and we believe it will, has the potential to double, triple some of these sectors. Like the energy sector, we think is a triple. The sector, right? Not to mention the individual stocks over the course of, let's say, 5 to 10 years, right? So I just want you to think about this, and I'll be happy to extend this another couple of minutes here. I'm going to take a quick pause, and I'd like to open this up for any potential questions you may have, right? But think about this. If you're not a trade ops member, think about it, write it down, some questions, come back tomorrow. Maybe you can ask if you have a question or two. But I would like to invite you to really think about what I just mentioned, right? And how does this translate into your portfolio, assuming you have one, or even if you're just trading, how does this affect your trading strategy? Because as money moves out of a major market at the margin, like tech, it also means there's going to be less momentum chasing in that part of the market, right? So if you're a momentum chaser, and this is not a negative word, it's just the definition by what one does if one is trading momentum, and you're probably largely focusing on tech, one is probably largely focusing on tech, that might stop working, right? Or it might stop working as well as it has, okay? So if there's no questions here, I'm going to assume that everyone totally gets this. I do appreciate you guys joining us here today on a Monday morning. I hope it was helpful. Again, everyone that's in trade ops, we're going to see you there in about 15 minutes, and I'll probably going to type in about 5 or 10 minutes from now. I'm going to share with you guys over in Trade Ops an idea that I think is really interesting. It's a bit more aggressive. It's very short term, but I think it could be an interesting one. So yeah, all of you, and thank you, John, for pointing it out. If you gave us a thumbs up like on all the videos, including this one right now, that would be amazing. That allows us to continue to do the show. Subscribe to the channel. That way we can continue to do it. It also, more importantly for you, allows you to be able to be updated in real time when we do this, when we come up with new analysis and live shows like this, and so on and so forth. So thanks for being here. I hope it was helpful. Give us a thumbs up like, and we'll see you guys back here tomorrow morning. And again, if you're in Trade Ops, I'll see you in about 5 or 10 minutes with an idea that I think is really interesting here right now. See you soon.